Good afternoon, everyone. I am Idisenemi Holiday, your moderator for this webinar session, where we'll be delving deeply into the red flags in tax audits. This session is duly organized by Stransact Chartered Accountants. Stransact is a correspondent firm of the RSM network in Nigeria. And currently, RSM is the sixth most powerful network of tax, assurance, and consulting experts globally. For almost 2 decades, Stransact has been involved in providing applicable solutions to business problems. At Stransact, we make our clients' problem our problem, and we offer the quality of a big firm and the attention of a small firm. Joining me in this webinar session are 2 seasoned professionals. Our first speaker is Ruth Bankole, a senior consultant in the People and Regulatory Services Unit, Stransact Chartered Accountant, and she has extensive experience in providing strategic business insights to clients. While our second speaker is a partner in the People and Regulatory Services Units with over 15 years of experience in providing tax advisory, commercial, and regulatory services. He is Yomi Sarao. During this session, we're going to be looking at an overview of compensation, its related tax risks, the impact of Finance Act 2023 on the Personal Income Tax Act 2011. We're going to be looking at the PAYE audit cycle and the tax implication of an inadequate cash inflow narrative. So before I call on our first speaker to take on the virtual podium, please note that during the course of this webinar session, if you have any questions, kindly drop them in the chat box and they'll be addressed at the end of the second session with the second speaker. So to our first speaker, Ruth Bankole, who will be taking us through the classification of compensation tax, its related tax risk, and how companies and executives can manage or mitigate such risk. Please, the virtual podium is yours. Thank you.
Thank you, Idise. Good afternoon, everyone, and welcome to today's webinar. We have a really interesting topic here, tax audit red flags. So in this section, we'll be looking at the meaning of compensation and the risk associated with compensation with respect to employer and employee. So before we move to what compensation means, I'd like to draw attention to the meaning of emolument as defined under the Personal Income Tax Act 2011 as amended. Emolument means salaries, wages, all allowances, bonuses, perks, and compensation. Compensation now can be grouped into 2 main categories. We have the cash compensation and the non-cash compensation. Cash compensation, I believe we all know what cash compensation means, but to further break it down, cash compensations can be basic salary, housing allowance, transport allowance, and other allowances. So there are salient areas, there are salient items with respect to cash compensations. We have the cash reimbursement and travel advance. Travel advance could be an amount paid to an employee as a result of carrying out an assignment on behalf of the employer in another location. This is given to the employee to cater for expenses that the employee can incur as a result of carrying out such assignments on behalf of the employer. On cash reimbursement now, cash reimbursement can be out-of-pocket expenses incurred by an employee on behalf of the employer. So on the part of the employee is expected to adequately retire this expense to avoid tax issues. While on the part of the employer, while making such payments to an employee, clearly stated that this payment is a reimbursement or a travel advance, so that in the hands of the employee, it will not be subjected to tax in a case where the employee has other sources of income. So we'll be focusing more on the non-cash compensations now. Non-cash compensations are benefits in kind enjoyed by an employee as a result of being in employment. And we have various examples of this. We have health insurance, education assistance, trainings, retirement benefits, e.g. pension and gratuities. Then we have employee perks. Employee perks now can be in form of company cars, accommodation, or stock options. Stock options has a very complex tax implication, so that will be a topic for another day. But I would like to draw our attention to Section 4 and 5 of the Personal Income Tax Act 2011 as amended, which talks about the tax implications of these benefits and how they are captured for tax purposes. So firstly, I'll be classifying it into 3 cases. The first case is a case where the employer provides an asset. For the employer owns an asset and the asset is being used by the employee. In such case, 5% of the rateable value of such assets is subjected to tax in the hands of the employee. While the second case is a case where the employer is not the owner of the assets, but the employer hires the asset or rents the asset for the employee's use. In this case, the annual value of such assets will be deemed to be taxable in the hands of the employee. The third case is a case where accommodation is being provided to the employee. And we have 2 scenarios that can play out under this case. The first one is a situation where the employee pays no rent. And the second case is a situation where the rent paid by the employee is lower compared to the annual value of such premises. So in the first instance where the employee pays no rent, the annual value of the premises will be deemed to be taxable in the hands of the employee. While in a situation where the amount paid by the employee is lower compared to the annual value of such premises, the difference between the annual value of such premises and the amount paid by the employee will be deemed as additional benefits to the employee. So moving on, we'll be looking at the tax implications of giving these compensations to an employee. Tax risk is the possibility that a taxpayer will incur unexpected tax liabilities over and above what the taxpayer is prepared to or can pay. So risk that can evolve as a result of compensation being paid to an employee could be transactional, operational, or reputational risk. That is, the risk can influence it can tarnish the image of the company or the employee. So we'll be looking at examples under this. The first example we'll be looking at is employee misclassification. This is the risk that an employer will classify his employee as an independent contractor, or the risk that an independent contractor will be classified as an employee. We have seen a case where a company doesn't have an employee for a fiscal year, but in their financial statements, under the staff cost, they classified the transaction amount paid to the independent contractor, which was hired that fiscal year. They classified it under their staff cost. And the IRS during tax audit picked this figure and subjected it to tax under the PAYE scheme. So to avoid this kind of issues, employers are encouraged to properly classify their employees. If you have an independent contractor, classify the person as an independent contractor. And if you have an employee, subject the person to tax under the pay as you earn scheme. So the contract that an employer gives an employee is contract of service, while the contract between an employer and an independent contractor is contract for service. So the next one we'll be looking at is underpayment of tax on bonus or performance incentives. I know a lot of us complain that our employer deducts enormous tax from us. Me, myself, I complain that the tax being deducted from me is really huge. But since I learned to understand that if the employer doesn't deduct the appropriate tax, then it will bring up additional liability. Majorly, the responsibility to deduct PAYE falls on the employer. But in a case where an individual or an employee has income from other sources, then the employee too will be subjected to additional tax liability in a case where PAYE has been under-deducted. So we have seen cases where a company will just charge a certain percentage on the amount of bonus to be paid to the employee and withhold that percentage and remit the same to the relevant tax authority. This would have resulted in some individuals being undertaxed and some being overtaxed. So this would in turn result in additional tax liability for the company. And in the case of employees that have income from other sources, it would have resulted in additional tax liability on their own part. And this would have they would have incurred penalty and interest in accordance with section 76 and 77 of the Personal Income Tax Act. So the third one we'll be looking at is risk associated with stock options. Just like I mentioned, that stock option has complex tax implications. The issues can be at the vesting stage, the exercising option, or the sale of the option. So we have complex tax implications of an employer providing stock options to its employee. The last one we'll be looking at here is non-compliance with tax laws. This is the failure to comply with relevant tax laws. And in this case, we are seeing, okay, imagine an employer. Imagine an employer still using the old way of calculating the consolidated relief allowance. This would have resulted in the underpayment of tax. It would have resulted in underpayment of tax. So employers are encouraged to stay up to date with relevant tax laws in order to avoid additional tax liability. So how can you manage this risk? Tax risk management is therefore about understanding where these uncertainties arise and making judgments about how to best deal with them. So how can you manage this risk? The first one is ensure that your employees are properly classified. Ensure that your employees are properly classified. When issuing out contracts to employee or independent contractor, ensure that the contract issued to an employee is contract of service and not contract for service. The one issued to independent contractor is contract for service and not contract of service. Next thing you need to do is ensure that appropriate employee compensation structure is in place. You need to ensure that appropriate compensation structure is in place for your employees. Properly classify if it is basic salary, housing, transport, all bonuses or allowances that is being paid to them. Ensure that you properly structure it in a way that it will not bring up additional tax liabilities. Then be aware of your options. In a situation where you are granting stock options to your employee, be aware of your obligation as an employer at the vesting stage, exercising the option, and the sale of the option. Then be abreast of amendments in tax laws. We have 4 amendments to the personal income tax we have 4 amendments in the Finance Act. We have Finance Act 2019, Finance Act 2020, Finance Act 2021, and Finance Act 2023. So as an employer or an employee, you need to be aware of amendments made in these laws to Personal Income Tax Act, Capital Gains Tax Act, and the Nigerian Labour Act. So to round it off, to effectively manage this risk, employers need to invest in appropriate payroll structure. This is why companies need to employ the service of a reputable professional service firm like Stransact to help them manage their payroll system and devise appropriate compensation structure for their employees. So I'll be handing back over to Idise. Thank you.
Thank you so much, Ruth. It was indeed an insightful session. Risk associated with tax audits could be transactional, operational, or reputational. And she went ahead to say, it is the duty of the employer to deduct PAYE, not the employee. Thank you so much, Ruth. So I've made my own notes. I learned a lot, and I'm sure you learned a lot too. So to see that our audience have been following on our conversation so far, a poll has been launched. The poll has been launched. Kindly engage. We want to see your engagement, so engage to test the knowledge you've acquired so far. We'll have a period of 5 seconds to attend to this. 4 seconds more. I'll be closing the poll in the next 3 seconds. To all our participants who are actively engaging on the poll, we say a very big thank you. 2 seconds to go. If you've not engaged the poll, kindly do so. 1 second to go. And we'll call it an end from our end. So I'm ending the poll. The result is on your screen. So a bonus is a taxable payment. Allowances are taxable. The status car is taxable because it's a benefit in kind. And share-based payment, based on our conversation this afternoon, is also taxable. So reimbursement is the answer to our brain teaser 1. Thank you all for participating actively in our poll. Moving on, we're going to be calling our second speaker for the day, who is going to take us through the tax implication of an incorrect or inadequate cash inflow narrative. And he's also going to talk about the impact of the Finance Act 2023 on the Personal Income Tax Act 2011. And he's going to round it up with the PAYE audit cycle. I am so interested to hear from him, and I'm sure you are too. So over to our second speaker, Yomi Salau. Please, the virtual podium is yours. Thank you.
Thank you so much, Idise. Good afternoon, everyone. I will continue from where Ruth stopped. The obligation to deduct PAYE is on the employer, but in the case where you have some other sources of income, complications can arise that will bring about some of these issues being dragged back to the employee. So quickly looking at what has happened in the past decade and what amendment the Finance Act has brought about in how we deal with personal income tax acts. In 2011, the act was revamped and a lot of amendments took place. Between 2011 and 2019, some organizations were struggling to actually get it right. While they are getting it right, the Finance Act started rolling in. And since then, it has not remained the same. Though the changes are not so major. One is the minimum wage that is fully exempt. So anyone earning the current minimum wage, which is 30,000 or below, will be fully exempt from tax. But there are some technicalities around that, especially when your minimum wage has some one-off additions to it. So you need to have a professional help you out. Other amendments to it include the pension, the premium paid on life assurance. Before now, there is always controversy around what type of life assurance will qualify for a relief and which will not qualify. So the recent Finance Act has made it clear that even premium paid for deferred annuity is an allowable relief. So it makes it very clear that, okay, any life insurance policy you are going for, we fully allow you for reliefs. And at the point of payouts, then you deal with the tax. So it allows for deferment of tax during the period. In addition to that, a major change that has been introduced, which a lot of individuals and companies are still struggling with, is the redefinition of gross income when it comes to consolidated relief allowance. Gross income before now has to do with all your taxable income less tax exempt items, but now is now being defined to include your gross income less tax deductible items. So which means when you arrive at your gross income, instead of just levying 20% plus the higher of 200,000 or 1% of the gross income, you rather check 20% of gross income less other reliefs such as pension, NHF, life assurance, interest on mortgage loan, and other items that qualify for reliefs. So in essence, what it means is if you have a lot of other reliefs, the consolidated relief allowance you are enjoying may be reduced compared to the person that does not have other relief. But that does not mean that you should not plan your structure so that you enjoy the benefits of those reliefs, because it's just a marginal reduction. It does not, you still pay higher than someone that has other reliefs, such as life assurance and interest on mortgage loan. So we quickly move on to the tax exposures that you have from cash flow narration. Before now, the IRS does not really look at what is happening in our bank accounts and the transaction notes. But given the current economy situation, everybody is aggressive, and the IRS is overly aggressive when it comes to what comes in and out of your accounts. So it is important for every taxpayer to know that you don't just have pass-through transactions with the wrong narratives. You need to have the proper narrative on your transactions, otherwise they will be deemed as income, though they may be pass-through transaction. For example, Mr. Hay has given loan to his friend, Mr. B, a loan of say 100,000 naira. And perhaps before the end of the year, he has given loan like 6 times. So 100,000 in 6 places, that's 600,000 naira. So when giving the loan out, it is important that you give it the right narrative, loan. And if possible, loan to, you can put the name of the person. So by the time the outflow is going out of your account and gets into the accounts of the recipient, it reflects what it is, which is loan. So it's not mistakenly taken as income in the hands of the recipient. And it's also important that you demand that when the loan is being refunded to you, the proper narrative is given to it, which is refund. So if you don't make that narrative clear, the IRS will demand that you pay tax on it. So the onus will be on you to start defending and explaining and proving that that is not an income. It will take you a lot of time, but the best would have been to have the right narrative. If you have the right narrative, then it saves you the stress of trying to come to the IRS to explain things like that. Another example is where, based on what Ruth has earlier said, companies are giving out out-of-station payments to an employee. The out-of-station advance is not an allowance. So oftentimes you see people say, oh, out-of-station allowance. An allowance is having a different meaning when it comes to taxation, because it's taken as an income. So to avoid the long drag and explanation, make the narrative very clear. Out of station advance, and when the expenses are incurred, keep proper record. A classical example on the pass-through transactions in the account is where a friend is a treasurer of their village association, and they plan, it's more of an NGO group, they plan to renovate their school, and everybody started contributing. It's not a formal association, so they don't have it registered. They don't have a bank account in the name. So his account was used as the receiving account. So everybody contributed into his accounts, and they were able to raise about 20 million naira. So the following year, the IRS knocked at his door, sent him a letter that he's been receiving a whole lot of money. But good enough, he has good record-keeping habits. He has prepared the schedule in a way that is very clear. The dates and the amounts that were being transferred to him, he has all of them on file. He has printed, even on the association's data-headed paper, they have them signed, and when the money was actually disbursed, he has the date and the amount on it. So he used that as a proof to let them see how those inflows came in and how they were dispensed on behalf of the association. That was the way out for him, and he made it very easy for him to explain to the IRS that, see, this 20 million that has come in is not an income, it's actually a contribution that was used for a charity. So it is advisable that we ensure that we keep proper narrative in our banking transaction. Don't forget that based on the Finance Act, the IRS, the bank is having has the duty to make certain information available to the IRS. And based on Finance Act, it's compulsory that every bank account has a BVN. If you check with most of the IRS that have gone automated, bank verification number is one key data they will collect from you. So what does that mean? Anytime they are suspicious of transactions, they can easily check with the bank, especially when you have transactions above 5 million naira. They can easily check with the bank to see who and where transactions are going to. So please don't be caught unawares. Yes, we'll go into the audit circle, but before going into that, it's very important that we clearly mention things that bring about this risk, the red flags, especially for executives. A lot of people would think, okay, executives are really the luxury ones, the big boys and girls, those who have a lot of money. But unfortunately, the IRS in Nigeria have not come out with a definite description of who a high net worth individual is. So, but based on practice and interaction with the IRS, we've come up with certain parameters that we have seen as the basis for choosing or determining who is high net worth individual for tax purposes. One of such is when you have luxury assets, maybe you have a mansion somewhere in Lekki, you are assumed to be an high net worth individual. The focus is actually not on your mansion. The focus is on the possibility that through that mansion, you may be earning other income. So rental income may be flowing in through that mansion. So because of that, they assume you to be a high net worth individual. Another one, another funny example is recently someone acquired a car of about 20 million naira, and after some weeks, he got a love letter from the IRS, and the letter is like, congratulations, Mr. XYZ. We are happy to know that you just acquired a new car. He mentioned the model and even the plate number. And we wish you all the best and hope you enjoy the car. Meanwhile, this is an opportunity to also remind you not to forget to file your tax returns. And the man was, what? So they already got his details. So yes, you may not have a landed property, your name is not in the land bureau, you don't have a real estate, but there are certain cars that they deem that is a certain class of people that have them. So if you have one of them, believe you me, you are a high net worth individual in your class. Another one is when your annual income is in the range of 50 million and above. Before now, it used to be around 100 million, but the economy is red. So they are looking for, everybody is looking for money. So the rating has dropped. So 50 million and above, you probably be classified as high net worth individual. One other one that is key is if you're a director or shareholder in a company in Nigeria, a limited liability company in Nigeria. So whether you are a shareholder or a director, you are deemed to have the prospects of receiving other income outside of your employment. So the IRS typically think anyone that is a director has the chance of getting director's fee or sitting allowance, irrespective of whether the company is dormant or not. You will probably get served an additional assessment or audit notice if you are a director of a company. So Having said that, so we quickly look at the circle. What are the things you need to do at the beginning of the years? What are the things you need to do during the year? And what are the things you need to do at the end of the year? At the beginning of the year, you ensure you file all relevant tax returns. For companies, the returns for 2023 income year will be due by 31st of January 2024. So before 31st January 2024, ensure you have compiled your record, get the appropriate information, fill them out, and file before the deadline. A lot of people will wait until the last minute. You don't need to do that. If you don't have the capacity in-house, you can contract a professional tax consultant like Stransact to help you out on this. We know how to do it and do it well. For individuals, the deadline for filing of your returns is 90 days into the commencement of the year, which typically is 31st of March. So you ensure that you have put all your records in place by the end of this year. If you need to look at your bank statement to see those transactions that have gone in, interest from the bank, dividend that you've gotten, your rental income, your salary, if there are other allowances, we put them together. Yes, dividend is franked investment income, and interest based on the provisions of the Personal Income Tax Act. Interest, the withholding tax deducted by the bank, is the final tax payable. Though interest and dividend will not suffer additional taxes, you still need to declare them so that you don't have hidden income. After ensuring that you have filed, you also need to be sure that you have all the receipts. Sometimes filings are done without full receipts. You have evidence of payments in form of teller or a remitter receipt or invoice. Ensure you get the original revenue receipts from the IRS, because that's what will stand the test of time. Sometimes the postings may go into the wrong account, but getting the right receipts will ensure that the posting is in your name. Then you can also carry out an internal review of what has happened, the compensation you have received as a company, the compensation that has been paid to employees. Ensure that you looked at them, and where you need to give narratives, then you have them on ground. For instance, if you have looked at your bank statements, transactions that you cannot easily remember, then you look at the documents that can guide you on the right description. You have them in place. Then if there is an underpayment that you have discovered based on your review of your income, then you can provide for it and quickly make the remittance. What that does for you is, if you make the remittance as a company on or before 10th of January 2024, it will not suffer interest and penalty, because you will still paying within the statutory deadline of 10th of January. So if you have done your computation, and if you require the services of a professional tax consultant, you can reach out to us. We be happy to support you in that regard. But ensure that you've done the appropriate check to ensure that if there is under remittance, you quickly make that payment. And also, if there's overpayment, that's also another red flag. It is better you quickly notify the IRS now, write them a letter, explain what has happened. Probably there was an error while making payment during the year. Make this explanation ahead of time. So when audit is coming up, it's not seen as an afterthought. It's not seen as if you're trying to hide something. You have made it known to them, and you have called their attention to it, and you can actually get credit for it for subsequent period. In the course of the year, you ensure that you have your proper documentation. So for instance, we are still in the course of 2023. Ensure that all documents that are required, you have them. For instance, if you have paid travel advance to an employee who is yet to retire it, ensure you have all these documents collected and kept properly. So if salaries are paid, check for the evidence of third-party support documents from your bank. Ensure you keep them on file because you will need them later in future, and the future may be 2024. So you also prepare your mind to know that very soon an audit may take place. For an individual, it is becoming regular, especially when your income is 50 million and above, or you are a director in a limited liability company. So we move on to what you need to do at the end of the year. Ensure that you put proper measures in place. For a lot of people, the mistakes they have made in previous years, they are yet to correct them. But that's not what is meant to be. You are meant to ensure that you correct any anomaly you have in previous years and learn from it and move on. So whatever you have learned from previous years, ensure that you have put proper measures in place to ensure you don't fall victim of it subsequently. Otherwise, you become a cash cow. The IRS in Nigeria, what is typical of them is when you are found to be a defaulter. For instance, last year you have paid 1 million, then this year they are assuming that you should pay something around 1 million plus 10% minimum. And if that continues, you get to a stage where the IRS is demanding 50 million from you. So you need to ensure that you do the right thing. It's actually cheaper to comply. Also ensure that when an audit is happening, you, as much as possible, do not interface directly with the IRS team. It's advisable you get a professional tax practitioner. Stransact will be here to assist. If you need our support, we are happy to support you. What that does is the consultant is able to speak the language that the IRS understand and communicate clearly. And they are able to also look and review the provisions of the tax laws to ensure that you are not in contravention of any of the provisions. And if you are, you will be adequately advised on how to remedy it by either paying the shortfall or providing documents that may be required for it. One other thing that comes to mind, which is very important, is the reporting that we have, especially as organizations. I've seen a situation where I think Ruth mentioned one earlier, where a company that has an outsourced service provider reports that invoice value under wages and salaries, and it became tug of war. So the question is, you need to go and bring the invoice to justify. The other thing is, are you sure this invoice is what you posted here? So to avoid all these questioning and time to be wasted on that explanation, it's good that you do your reporting properly. Another scenario is where a company has posted all sorts of transactions under wages and salary. For instance, a third-party vendor was posted under wages and salaries. Payments for training was posted under wages and salaries. I'm not talking about staff costs now. Under wages and salaries, training you have it there, and a whole lot of other expenses that are not even related to employee. We need to ensure that we have a proper reporting system in place to avoid issues like this. So what are the major things that come up during an audit? The taxman will always say, okay, based on whatever information they found out about you, they want to deem an income for you. I can easily look at root and say, okay, yeah, you're looking good and you have a very good car. So based on that, your income should not be less than XYZ amount. That is wrong. But that is what always come out. So for you to defend that, you need to come out with your actual salary. And the best time to do that is when filing your returns, because every other document you are bringing will align with that return you have filed, and it makes it very easy for you. Also, ensure that your contract is well looked into. If there are ambiguous clauses or terms, you get them well explained and consider the tax impact. The other issue is the IRS will be deeming benefit in kind, all sorts of benefit in kind. The mere fact that you are a director, they will deem that you have a company car, you have a company driver, you have some stewards, you have this and that, a whole lot of, which most times are not true. So the best practice is for you to declare the actual benefit that you have enjoyed. And with that, you easily close the case. Reimbursable expenses is one thing we've talked about. Yes, get your document to support these expenses or pass-through transactions in my account are not income. Support with necessary documents, and you'll be surprised that these issues will easily be dropped if you have the right professional tax consultant supporting you. I think because of our time, I will be handing over back to Idise. If we have further questions, I'll be happy to attend to them. Thank you.
What a session. As I said earlier, I started taking notes from the beginning of the session. So I would read out what I noted, not all, due to time constraints. Given the current economic situation, it is important for every taxpayer to have the proper narrative on transactions, else they might be deemed as income. And a whole lot of insights we just dropped here and there. Thank you so much, Yomi Salau. It's been indeed a very insightful interactive session with you. So if you have questions, our question and answer chat box is open. So please do drop your questions there and they'll be addressed after we launch our poll. So as I said earlier, I was following, and to be sure that our attendees were following attentively, we are launching our second poll. And it's for a period of 5 seconds. What can make a person to be classified as a high net worth individual? What can make a person to be classified as a high net worth individual? Is it ownership of a luxury asset? Is it annual income of 100 million naira or more? Is it being a director or shareholder? Is it all of the above? But do you think the right answer is none of the above? Please do engage the poll. While doing so, kindly drop your question in the Q&A box. We have 4 seconds to go. Do drop your questions in the Q&A box. We have 3 seconds to go. What can make a person to be classified as a high net worth individual? We have 2 seconds to go. We have 1 second to go, and we'll be calling it a day for the poll from our end. Thank you so much to all our participants for participating actively on the second poll. So we can see the answer right there. I can remember vividly, I didn't want to write it down because your misstated it. Ownership of a luxury asset can make you to be classified as a high net worth individual. Annual income of 100 million naira or more will bring the IRS eyes to you. Being a director or shareholder, they're coming to your door knocking. Please, you know what to do. Thank you so much to all our participants. So we're moving on to our chat box. And we have questions here. So the first question, employees of a company who work as casual employees in the company's factory, whose wages are paid on a bi-weekly basis, and the bi-weekly wages is less than 30,000 naira, are such employees subject to tax? I'll take the question again. With our first speaker, Ruth Bankole, is going to handle this. Employees of a company who work as casual employees in the company's factory and whose wages are paid on a bi-weekly basis, and bi-weekly wages is less than 30,000 naira, are such employees subject to tax? Ruth Bankole, please, the virtual podium is yours. Thank you.
So according to the Personal Income Tax Act, employees earning the minimum wage are exempted from tax. That is, the minimum wage currently is 30,000 naira. So employees earning an annual income of 360,000 are exempted from tax. But in this case, the employee is earning a bi-weekly wages of 30,000. That means monthly the employee is earning 60,000, which on an annual scale is 720,000. So therefore, the individual is subjected to tax, is expected to pay tax. Either your employer deducts this or not. As an individual, you're expected to pay the tax. And the responsibility to deduct this is on your employer. So if you have sources, even if your employer doesn't deduct this, if you have income from other sources, then you'll be expected to pay tax on these wages.
Thank you so much, Ruth. I think you've done justice to that. So we'll be moving on to our second question, and this is directed to Yomi. For musicians and footballers generating income both within and outside the country, are they subjected to personal income tax? Don't worry, you'll get your answer. Yomi, please, the virtual podium is yours. Thank you.
Okay, thank you. I believe the musicians and footballers are individuals. So if they are individuals, then they are subject to pay personal income tax. But there are caveats. Based on provisions of the Personal Income Tax Act, an individual is subject to tax on his worldwide income. So irrespective of where he's making that income, but there are certain income that are exempt from tax if they are brought into Nigeria through government approved channel. And this is not one of them. But the other key question to ask is the residency. The Nigerian tax law is based on residency. So is the musician resident in Nigeria? Is the footballer resident in Nigeria? If the answer is no, then they are to pay tax, but not in Nigeria. If the answer is yes, they are to pay tax in Nigeria. So if you are a musician or footballer, please, our door is open. We can discuss further.
Thank you so much, Yomi, for that. Our door is open. This third question is directed to Yomi still. If I get a love letter from the IRS, who should I talk to first? My lawyer or Stransact? If I get a love letter from IRS, who should I talk to first? My lawyer or Stransact? Yomi, please, over to you.
Thank you once again, the answer is talk to Stransact. We're talking about tax matters there. So the issue is coming from the tax office. If there is need to consult your lawyer, we'll let you know. But the right person to deal with the tax matter is a tax professional. So please consult Stransact.
Thank you so much, Yomi. I'm tempted to answer this question, but I will not. I'm very tempted because I listened attentively. So Ruth, over to you. Why should reimbursable income be taxed? Ruth, why should reimbursable income be taxed? I know you've done justice to this question earlier on, but we'll be honored to have you do justice to it again. Thank you.
Okay, reimbursable income is exempted from tax because it is an out-of-pocket expense which you incurred on behalf of your employer. But there are situations where it can be taxed, it can be picked for tax. This is why Yomi stated that proper documentation should be in place. If while making the reimbursable payments to the employer doesn't clearly state it that this is a reimbursable expense, if the individual is picked for tax purpose, that is, the individual is being assessed, then the tax authority, knowing that, okay, ABC Limited is the employer of Mr. A, then they saw an income of, let's say, 100,000 coming from ABC Limited without proper description that this payment is a reimbursement to Mr. A, then the IRS can pick this and subject it to tax. They will take it as a taxable income. But if there are proper documentation to clearly back up this payment to Mr. A as to state it as a reimbursable expense, then it will be exempted from tax. So normally, reimbursement is not subjected to tax.
Thank you so much, Ruth. Thank you. Yomi, do you have anything to add to that?
I think it's straightforward. If it's an expense and there is no gain made from it, it's not taxable. The only challenge is where you have, for instance, called it reimbursable allowance or something. You have used some funny nomenclature and you don't have the proper documentation. But if you have the right documentation, it's not a taxable inflow. It's just a pass-through transaction.
Thank you to our panelists so far. I would say you're doing an exceptional job. So the last question, which is directed to Yomi, at what time is life assurance premium expected to be received in the future, subject to PAYE tax? At what time is life assurance premium expected to be received in the future, subject to PAYE tax? Yomi, please, the virtual podium is yours. Thank you.
Okay, thank you so much. Life assurance, do not forget, when you're making that premium payment, you get relief for tax purposes. So when you are getting it back, there are different scenarios. When life assurance compensation is being paid, most times they get to the beneficiary. So in the hand of the beneficiary, it is not taxable. It could go to a trustee. In hands of the trustee, it is not taxable. But if is redeemed by the insured, that means maybe before the end of the termination, before the end of the contract, you terminated it and you receive it, then it becomes taxable, especially the interest. There will be some interest that will have accrued on that payment. Do not forget that this is a payment that has been separated from other income for you and that has not been taxed. So when you are now getting it back, it's a form of refund to you. So at the point of that refund, it becomes taxable, especially the interest on it, the interest elements. Hello, I hope that's clear.
Yes, it is. It's quite clear. Thank you so much, Yomi, for doing justice to that. The questions are a lot, and we would really love to stay back and address all questions asked. But due to time constraints, we'll be bringing the session to a close. We want to say a very big thank you to all our participants for your time. We say a very big thank you to the technical team, our facilitators, and our able panelists. Thank you so much. We understand that due to time constraints, we are unable to handle all questions asked. However, you can reach out to us via our contact details displayed on the screen, via email, phone call, or you can also visit our website. You can also check us out on our social media platforms. Do note that we have a dedicated YouTube page that can answer most of the questions we have here. So kindly stop by at our YouTube page, like, and please don't forget to subscribe. Once again, thank you all for your time, and thank you to our panelists. Till we meet again, or as I said, we look forward to meeting you to enjoy the rest of your day. Have a very good afternoon. Thank you.